Okay, so quickly, the profitability ratios, we saw 4 of them. The gross profit margin or gross profit percentage, the net profit margin or net profit percentage, and then the return on capital employed, as well as the return on shareholders fund. Okay. And we also indicated that the higher the ratio, the better in terms of the business performance. Let's look at liquidity ratios. Liquidity. In accounting, when you hear the word liquid, we are referring to cash, right? Cash. So liquidity ratios, these are ratios used to describe a business ability to convert assets into cash, right? Or better still, we should say to convert other assets, because the cash itself is an asset. So the main motive of these ratios is to look at how the business is able to, transform other assets into cash to meet its maturing and pressing obligations, right? So the essence is we want to tell the users that, oh, this business is able to generate cash from other assets to settle liabilities. That's the essence. Now, fortunately for us, we are only going to look at 2 ratios under this type of ratios. So the first one is the current ratio, and the second is asset test. At least we have a scientific term here. So current ratio and asset test ratio. What is the current ratio? The current ratio is looking at the relationship between your current assets and current liabilities. So the fact is that it wants to measure whether your current asset can settle your current liabilities if the need arises. Okay, so it says it's a ratio that is used to measure the extent to which current assets can be used to settle current liabilities. So the formula is simple. It's your current asset divided by your current liability. And here we don't multiply by 100%. We compare it to 1, right? So normally, if you do the division, you might get maybe, imagine if your current asset is 20,000 and your current liability is say 10,000, you do the division and you compare to 1. So at the end of the day, you are going to arrive at something like 2:1 as your answer. Okay, so that's how we do the computation. Now, we compare to 1 because there's a rationale behind it. If it is greater than or equal to 1, then we say the business is doing well, right? In terms of converting other assets into cash to pay for liabilities. But if it is less than 1, then that business is not looking good. So we say that that business is having liquidity issues. Okay. I think you've heard this term, liquidation. Liquidation simply means that we are selling the assets of the business, or we are changing those assets into cash so that we can settle our creditors and other liabilities. Okay, so normally when a business is collapsed, that's what happens. It is liquidated. So they sell all the assets to get the cash to pay off the liabilities and any remainings for the owners or shareholders. Okay, so that's your current ratio. The second one is asset test or quick or liquid ratio. In fact, it's very funny because it's the same formula, just that this time we are going to less stock from the current asset. So let me shift this up so that the formula would. So for the asset test ratio, the formula is your current asset minus stock, and I'll explain why we are deducting the stock, divided by your current liabilities. You see, the name of this ratio, quick. So we want to look at those assets that can be quickly converted into cash. Okay? So it measures how efficient a business is able to use assets which are quickly turned into cash to meet liabilities or outstanding obligations. Now let me do this, dear professors. You remember our current assets, right? On the face of our balance sheet, our current assets are stock, debtors. Then we come to the prepayment, the expenses prepaid. Then the income accrued. Before we look at bank, and finally cash. These are your current assets, right? Now, this arrangement has been done in order of liquidity. Please, if I'm rushing, prompt me to slow down. Okay. Now, when I say in terms of liquidity, it means that when you look at how quickly you can convert these assets into cash. Did somebody wanted to say something? Because I saw some flash of unmuted mic. Okay. So you see, cash is the most liquid asset because it is already cash. You don't have to even convert it. It's already cash. But look at stock. Before you convert stock into cash, you would have gone through some difficulties because first of all, you have to take the stock to your customer. Your customer may not pay you. He may defer payment to another day. When you go for the money, the person can give you a check. You have to go to the bank to cash it. So it really takes time to convert stock into cash. Compared to debtors, for debtors, you go there, the person gives you cash or maybe gives you check. You go in there to cash it. So between stock and debtors, we will say debtors is more liquid than stock because you can easily convert debtors into cash than stock, right? So in the balance sheet, the arrangement has been done from the less liquid asset to the most liquid asset. Okay. And please note this because objective or multiple choice, you do have some of these issues there. Which of the following is the most liquid asset? And you have maybe cash, bank, creditors, something. You're able to get that. Any question up to this point before we continue? Any question? Okay. Please, is the pace okay for you? Or I seem to be running. I can feel I'm running a bit because most of these things are easy to understand. But prompt me if I'm worrying you with the speed. So these are your liquidity ratios, right? Let's move on to the next ratio, and that is the activity ratios. Activity ratios. Okay, I think it's enough. You've heard my voice a lot. One person should volunteer to read activity ratios for us. Okay, I think I'll call Josephine. Prof. Josephine, please read activity ratios for us, as I've highlighted.
Okay. Activity ratios. They measure how efficient a company is with operations or activities, such as selling stock, collecting debts, and paying creditors in the maximization of profits.
Okay.
They are sometimes referred to as operating efficiency ratio. Below are some of the activities ratio.
Thank you very much, Prof. Josephine. Okay. I think my professors have beautiful voices. Maybe I should think about doing a collaboration to, have a music accounting base, right? So maybe Prof. Jacinda DJ, Prof. Ella will be the beat mixer. Prof. Amma maybe will do the lyrics, and the rest of us will combine our voices to do a. Okay, so that's just by the way. So activity ratios, as she read, you see the name activity. So it is looking at the activities that a business undertake. Now, the major activities businesses undertake are mainly is either they are selling stock, right? Or maybe they are going to purchase stock from their suppliers, or they are collecting their debts from debtors, or they are paying their creditors. These are the major things that businesses do, right? You get the goods, you sell them. If people are owing you, you go and collect them. You also have to pay people you owe. Okay. Now, one of the ratios we are going to look at here is called the debtors collection period. Debtors collection period. Because one of the activities is for the business to collect its debt. If you are not efficient in collecting your debt, it will have a bad impact on your business. This is even practical in our daily lives. If your friends are owing you and you are not able to collect your debt, I'm sure you go bankrupt, right? So it's important that a business measures its debtors collection period. So you say it shows how well a business is able to recover amount due from customers, right? Okay. What is the formula for this ratio? Very simple. Your total debtors, and you know that these debtors arrive because of credit sales. So your total debtors divided by credit sales. Okay. Prophecy, I think you have a question. Go ahead, please.
So if that's the case, so why do some companies do, I don't know, calculate for bad debt? Because like if you are not able to take it, they say the business will go bankrupt or something.
Yeah.
So why do they sometimes?
Okay. I love the question. I don't know if any of the professors want to express an opinion. If not, I'll go ahead and answer. So why bad debt? Because like you rightly put it, if you don't collect your debt, you go bankrupt, right? But bad debt is a necessary evil, if I should say, because there are times where circumstances beyond you, right, will lead to that, and you can't control it. So yes, bad debt can actually lead to a business being bankrupt. Let me take, for example, I don't know, there was this issue, this GN Bank issue. I don't know if you people are much into it, right? But what happened, according to what came in the news, was that the government owed the bank lots of money, right? And the government was not forthcoming. So as a result, the business or the bank didn't have enough money to pay depositors' money. And so it had to be shut down. Let me give you a practical example. So say Prof. Amma is selling shoes to colleagues, right? And then 20 students have bought the shoes. These 20 students include Prof. Echa, Prof. AC, Prof. Prof. Josephine, Mr. Moore. We are all included. And we haven't paid. Okay. Because we are not able to pay and Prof. Amma is also not able to collect, it will definitely become a bad debt, right? And that bad debt is going to affect Amma's business. Amma may need to shut down. Okay. But businesses put in steps to cushion the shock from bad debt. That is why there is this provision for bad debt. So as the years go on, they try to set aside some of the profit they make to cushion the losses from the bad debt. Okay, so bad debt can really collapse a business. Okay, just that the more reason why businesses need to appreciate that particular concept and make the necessary provisions so that in the event of any bad debt, they don't shut down or go bankrupt. So prophecy, that's the point. If you don't collect your debt and they become bad, your business is going to be affected, right? To cushion it, we put in the provision for bad debt. So I hope it's okay. You get the point now.
Mr. Moore, please, another question.
Oh, go ahead. Feel free. Ask me lots of questions. I'm ready for it.
So can you please say that for bad debt, unless like before you can say you want to like provide for somebody's debt being bad, your business has to like, you have to get like you should be making profit so that you can set some aside before you provide for bad debt, or since it's like a situation, when it comes you have to provide for it.
Okay, great question. If you look at one of the standards, accounting standard, is that we expect financial accountants to always make provisions, right? Because these losses, these bad debts are bound to happen. So this concept is the prudence concept. I don't know if you remember this. I think we looked at it the last time. The prudence concept. It requires that accountants make provisions, regardless of whether the business is making profit or losses. But most times it's more feasible when the business is making profit, right? So you don't need to wait for the bad debt to occur before you provide for it. You have to make the provision so that when it occurs, you cushion it. If it doesn't occur, then you take the money back. The more reason why we have decrease in provision and this increase in provision, right? I think I'll take my time and go to this bad debt and provision for bad debt. Okay. So let's hang it in there for now, Prophecy. But the question you asked, I think the reasons or the explanations I give fits it. Okay. So you don't have to wait for the bad debt to occur. You have to make the provision so that when it occurs, it can at least, if not settle all, it can take half of the burden from the business. Okay. And note that there are situations where these bad debts can occur, and we've listed them. Let me find out from my professors, please. What are some of the reasons why a debt may be considered bad? I'm waiting for you on this one. If you don't respond to me, I'm not moving forward. Why would a debt be labeled as bad? Remember, bad debt means the debt is uncollectible. You can't collect it. Yes, Prof. Senam.
I think maybe when your debtor dies, or the person that is owing you dies or something, so you know you can't get the
Exactly.
money back.
Exactly. When the debtor is dead, when the person dies and there's nobody to tend to, or even the terms of contract did not leave anybody to take over the debt, then we say Sikanashi. We Sikanashi. Yes, Prof. Jacinda, I wanted to say something.
Please, I wanted to say the same thing.
Okay, so thank you, apart from the death of the debtor, we also say if the debt is immaterial, I don't think you'll be chasing somebody who owes you 1 Ghana peso. Okay, because that money is immaterial, it's insignificant. Okay. The third one is
Mr. Moa,
yes, please.
please, you said that you know chase someone for 1 Ghana cedis, but how did that person get to owe you? Like, I feel
Okay,
like
so
me, I'll still go for it.
it's possible that the person owed you, say, 100 cedis, and then he sent you Momo 99 cedis. Or he sent you 100 by MTN deducted e-levy, so you got 99. I don't think you'll be worrying about the 1 cedi. Yeah, Prophet Fia is okay. So if the debt is immaterial, if the debtor is dead, or if the debtor goes mad, right? Or loses, sensibility, or I'm not sure you'll be chasing a mad person for your debts. It doesn't make sense, right? And then fourthly, if the person is declared bankrupt by a legal statute. Okay, so you see the banks that were collapsed, or even Men's Gold. I think you remember the popular one. You see, Men's Gold has not been able to pay a lot of people, right? And Men's Gold has officially been declared bankrupt. So in this case, if Men's Gold is your debtor, then Sikanashi, that's why a lot of people have lost their money. Unfortunate, but that's some of the realities we find ourselves. Okay. So that was just by the way. I think we'll revisit this bad debt provision for bad debt better. So the debtor's collection period is measuring how long it takes you to collect your debt. And the formula is your total debtors divided by credit sales multiplied by, because it's period, you can express it in days, weeks, or months. So in a year, we have 365 days, or 52 weeks, or 12 months. The question would tell you which period to express the debtors collection period. Okay. If not, then you have the luxury to choose your own metric. Okay. I want some of you, one person to read the creditors payment period as I've highlighted. So unmute and read for us. Oh, please go ahead and read, Prof.
To creditors payment period. It shows the duration in which creditors are settled. Debtors collection period is equal to total creditors times 365 days / 52 weeks / 12 months. Credit purchases. A longer period indicates that the business is given enough time to settle its creditors and that it is positive for the business. Should I continue?
Okay, I think you pause there so that we get the point well noted. Okay. So it's like the opposite of the debtors collection period. This time your creditors payment period. How long does it take you to pay your creditors or suppliers, right? And the formula is your total creditors divided by credit purchases. Okay, multiplied by either in days. Okay, Prof. Ella, you wanted to say something.
Certainly, the price says she's having problem connecting. That's why she is joining on and off.
Okay, well noted. I think I'm recording, so I will share for them later. Okay, thank you for that prompt. So it's your total creditors divided by your credit purchases. Why? Because your creditors result from credit purchases, right? So the formulas are easy to remember. Okay, just draw the link between the elements and you get it. Okay, but I want us to look at something here. There's some significant point we have to know. Between your debtors payment period and your creditors payment period, there are some things you have to pay attention to in terms of the longer period or the shorter period, right? So let me ask you this. I think I'll ask Prof. Ifya this because she's here now. Prof. Ifya, if somebody owes you and it takes you 2 days to collect your money in one scenario, and in another scenario, it takes you 10 days to collect your money, which of them would you say is efficient? Prof. Ifya, are you there? Yeah.
Yes, please.
Okay.
Please, the one you got in 2 days.
The one you got in 2 days, exactly. So it means that the shorter the period, the better for the business in terms of debt collection. Okay, right. But when it comes to the payment, the creditor's payment, the opposite is the better. As in, so again, let me give the scenario. If this time the business owes somebody, so you owe somebody, and it takes you 1 year before the person comes for his or her money, and in another breath, it takes you only 5 days for the person to come for his or her money. then we'll say that the 1 year is better because then you have some breathing space. Okay, your creditor is not chasing you for the money quickly. He or she allows you a longer period. So for the creditor's payment, the longer, the better for the business. But in terms of the debtor's collection period, the longer, the worse for the business. Okay, so note this, some of these things down for better understanding and comprehension. Okay, so that's a bit about the debtors collection and creditors payment periods. Now, let's look at the third one, which is the rate of stock turnover. Rate of stock turnover. So we just established that one of the activities of a business is to sell goods or sell stock, right? So let's look at this ratio. It measures the number of times stock of goods is being sold. The higher the rate, the better for the business, because that tells us that the business is able to sell its stock faster, right? What is the formula? The formula is given as follows: cost of sales divided by average stock. And you all know where to find your cost of sales in the trading account. Your average stock here is your opening stock plus closing stock divided by 2. Okay, so you find the average between your opening and closing stock. There are some questions you may not find your opening or closing stock. Whatever stock is there, use it as the average stock. Whatever figure you get, you just add the word times to it. So if you get 2 times, 10 times. And like we just said, if you have 2 times versus 10 times, then the 10 times is better because it will mean that the business is able to sell its stock 10 times. Okay. If I want to cite a scenario, if you are selling shoes with a colleague and your colleague within a month goes and bring the shoes, sell 10 times, you have only gone twice. That means your colleague is doing better, right? So the higher the frequency, the better for the business. Okay, the last ratio we'll look at under this, or let me say the last but one, is the sales to capital employed, right? And this ratio is looking at the relationship between your sales and the resources you have invested, the capital you have employed, right? So the formula is simple: your net sales divided by capital employed. And then we also have the sales to fixed assets, which is your sales divided by fixed asset. You want to look at how your fixed asset helps you to sell your goods. Okay. But like I indicated to you, dear professors, since we are preparing for WASSCE, the first ratios we've just seen, i.e., the gross profit margin. I think I need to write these things down for you, okay, to better appreciate it. So the first one, gross profit margin, the net profit margin, the return on capital employed. Then you have the current ratio, you have the asset test ratio, you have the debtors collection period, you have the creditors payment period, then you have the rate of stock turnover. My dear professors, you can check the past questions to see yourself. These are the most examinable ratios ever. Okay, so don't joke with the formulas for these ratios. Okay, now there are other ratios, as I hinted about, the leverage and the investment ratios. I think I'll leave that to you as a reading assignment, just simply because it's not highly examinable, number one. And I think my professors can better explore. Okay, but come to me with questions and I'll deal with them. So let's focus on these ratios. okay, which are of more importance to us. The others are equally important, but for now, let's focus on this one. So the gross profit margin, net profit margin, return on capital employed, current ratio, asset test, debtors collection, creditors payment period, and the rate of stock turnover. I want to ask a few questions before we end this session. The last session, we'll pick an illustration and solve. I'll be very glad if you can sort out this topic today. Okay, because it's easier, right? We just need to know the formulas, know how to pick the figures, and answer them. Okay, so my first question is, the asset test ratio is also known as, the asset test ratio is also known as, who is going to answer this question? Prophecy.
Please explain the quick ratio.
The quick ratio. There's a bonus question, right? So she got it easily. Well, let me pick the next question. The next question. What is the formula for calculating the rate of stock turnover? Rate of stock turnover. Rate of stock turnover. Okay, I think I'll answer this myself and then clap for myself. So the rate of stock turnover is given by the cost of sales, your cost of sales divided by your average stock, where average stock is opening stock plus closing stock divided by 2. Now I'm clapping for myself, for me. Okay. My next question is, can you, in your own words, briefly explain? Mami, I have a question. Please go ahead.
So please, can you come again with the formula for the rate of stock turnover?
Okay, so it's the cost of sales divided by average stock. Your cost of sales divided by average stock. And average stock is opening stock plus closing stock divided by 2.
Thank you.
Okay. Now, briefly explain the current ratio. Who is going to do that? In your own words. You can cite examples whatsoever, but briefly explain to me current ratio. What is it? My professors. Okay, Prof. Jacinda.
Please, in my opinion, I feel like it simply indicates the ratio. It's like a comparison between current assets to current liability.
Okay.
And then maybe like a higher, how do I say it? Like a higher current asset is a higher current asset is like it shows more financial stability of the business. Yeah, as I understand it.
Okay.
Please, am I correct?
My dear, you don't need to be correct. It's good you express your opinion. And yes, you have some point in there, very valid point made there. So, like you said, it's really comparing your current asset to your current liabilities. But the essence is we want to check if the business can be able to use its current assets to settle its current liabilities when they fall due. So the point you made there is very correct. Thank you very much.
Sir.
Yes,
Please,
Prof.
can you come again?
Okay.
The current ratio.
Okay. So let me do this. For all the 8, I'm going to go over and give you specific details so you can jot them. Okay. I have 2 minutes to do that. So let me quickly do that. The gross profit margin, right? is measuring efficiency, how efficient the business is in its trading activity. Okay, so is the business efficient in buying and selling of goods? Then the net profit margin, that looks at how the business is efficient in all of its operations. So when we say all operations, we mean your trading operations, investment operations, whatever operations that you are getting income or profit from. Then your return on capital employed is looking at how efficient the business is in using, so how efficient the business is in using its resources or its capital. Let me use resources from the owner to generate profit. Okay. Then the current ratio is looking at how the business can use its current assets to settle current liabilities. Okay. Then the asset test is focusing on how liquid assets or how quickly assets can be converted into cash to settle liabilities. Okay, so I'm sure some of these summaries gives you a better picture. Okay.